Hello, everybody. So, some of you have asked me about what I think about the Clarity Act and the excitement that we see on X about the Clarity Act potentially going up for a vote this May, potentially on the president's desk by July, end of July maybe. And so, of course, this could be an enormous catalyst for Bitcoin, for MSTR, which of course is the largest owner of Bitcoin, but also it could have implications for STRC and stablecoins in general. So I want to discuss this as it relates to our favorite investment, Bitcoin, MSTR, and I guess STRC if you like digital credit, which of course if you like MSTR, you like to sell digital credit. So lots of chatter. Potentially this summer, potentially on the president's desk, July, maybe August. The long story short is the banks won on the surface. On the surface, it looks like Coinbase kind of green-lighted the whole deal, and it looks like the banks won on the surface. The current version of the bill says you're not allowed to have a yield on a passive stable coin, and you're not allowed to say advertise yield on passive stable coins, etc. Essentially, passive stable coins have to pay zero like checking account. So if you just hodl USDC, you're gonna get nothing, just like in a checking account. The banks, on a first look, it looks like they got their way. But when you read what it says, you actually realize that I think Coinbase, lobbied for a loophole that's acceptable for them, which is the bill allows rewards on stablecoin for activity. And what is an activity in the stablecoin world? What is an activity in the highly, highly innovative world of crypto? Could be transactions, could be lending, could be spending, could be loyalty. So my guess is that they will find some sort of a rewards program that, if you look at the value of a reward, it will be something equivalent to the yield. They'll find a different way to give something that the banks can't give, right? That's kind of my take on this. I think they'll find a way. And if anything, they could find a way doing it on spending and giving a yield on spending. And it's like, well, whenever you spend your stablecoin, you can earn a fee, and then they would have different brackets. And maybe you max out after a certain bracket. And instead of calling it a yield, they call it a transaction for moving money around. Or, you could lending. You could incorporate stablecoins with, Aave protocols or all sorts of, even hyperliquid as lending, right? So you could do something like that. I'm not too worried. I think they'll be creative. I think they'll find a way. And so I think even though on the surface it looks like the banks won, in practice, I think they will find a loop around, as I call it. So this is a big win for crypto. And as an aside, of course, how did the banks win this argument? Well, I think they spent something like $100 million on lobbying on one hand, which is nothing compared to how much money they make on checking account unpaid yield. Okay, but they made that argument saying that, well, if stablecoins start offering yield, the whole U.S. financial system will see drainage in the checking account, and people will just drain the checking account and put the money in stablecoins on crypto rails, and that could create a systemic risk. And that is what they argued. Of course, if you follow that debate, you know that there is a simple way to stop people from moving away their money to crypto rails, and they conveniently omitted that. The simple way would be to just offer a yield and compete, right? If Coinbase offers 4%, why don't you offer 4%, JP Morgan? People won't leave if you compete. But of course, that wouldn't bode well for the profits of the banks. So they won this one, but I actually think Coinbase won too. I think they both won. And of course, the nature of politics is the banks lobby a lot. There's a lot of lobbying going on. And so these senators, they need people to help with campaign financing come elections. So anyways, that's just the way it works. But giving points to stablecoins, giving points to stablecoin holders as opposed to giving money is a very small price to pay in exchange for these tremendous benefits, including clear asset classification. What's a commodity? What's not a commodity, right? Oversight of intermediaries, oversight of exchanges, brokers, right? DeFi and developer protections. Don't go to jail if you develop something. I mean, or at least have a clear framework as to what you can develop so that you make sure you don't end up in jail. Stablecoin and banking provisions. We discussed that. Investor protections, illicit finance, and enforcement. Right? Anti-CBDC measures. Central bank won't get involved. And of course, this was a risk, especially heavily discussed in Europe, not as discussed in the US, but CBDC has been the big fear. This explicitly bans it. This is a major, major win. And, advancements on NFTs, DeFi, and all that sort of stuff, that's like the deep tech side of crypto, or the kind of edgier side of crypto. I don't follow that space at all. To me, the two most important things. There's two of the most important things going on here. First of all, I'm calling it banning illicit finance. Whatever you want to call it, like you want to call it regulation of exchanges, banning of certain practices from exchanges, I think is extremely bullish, because if you remove things like wash trading, if you remove things like allowing your customers to go 10x long on an asset, and then you see that your customer went 10x long on an asset, and so you make sure the price drops 10% so they get liquidated, that needs to stop. And we call it manipulation. What I think is that if this passes, I think you're still going to have a little bit of it to an extent. You can't ever entirely stop it, but I think it's going to be greatly reduced, and this is what we need for Bitcoin to run. So this is a big deal. Investor protections, removal of quote-unquote illicit finance practices from the big exchanges, right, who see their customers trade and liquidate their customers trade. I think that's a very big deal, and it will remove that ceiling that Bitcoin has been trying to pierce, is what I think. The other big deal, of course, is more money coming, because this regulates crypto. This turns the whole industry into a bona fide industry, a bona fide asset class, an asset class that is, touchable, but, kosher, I guess, is how you say in American English, a totally accessible asset class for everybody, which is still not the case. Bitcoin now, we can argue. I mean, the regulatory clarity is here on Bitcoin, but it's going to be here on the whole sector now. And so that means, a lot of new massive investors are going to come into the space. And I was reading about it, insurance companies could even start allocating some of that money to Bitcoin, right? Imagine if Berkshire Hathaway, what is it, 380 billion of cash? Imagine if they allocated some of that money to Bitcoin. So even insurance companies are going to be able to do that. This is going to be a huge deal. This is going to unlock even more money. And here's another point. So you may be pro Bitcoin, and you may say, well, pension funds can own Bitcoin now. Why do I care? Well, here's the thing. It's about getting a lot of money moving into the space, because the more money you have into the space, the more that money will stick to gravity. And what is the asset in the space that has the most gravity? It is Bitcoin. And I agree with that. I think many deep Bitcoin writers and thinkers have argued, and justly, I think, that the more dollars live on crypto rails, the more of these dollars you have, the more natural will be the increase of the Bitcoin. You will increase the value of the Bitcoin just by virtue of the fact that right now there's about, don't quote me on this, it changes and I don't have all of the data, but from just looking at CoinMarketCap, right now there's about $300 billion of Bitcoin trading on chain. And so you have one Bitcoin, which is the highest gravity asset that lives on chain, plus everything else, divided by 300 billion, right? If we have trillions of dollars moving to crypto rails, all of a sudden, you will still only have one Bitcoin. But instead of dividing it by 300 billion, you may divide it by $3 trillion. And of course, the whole market's going to grow as a whole. And of course, it's not all going to stick one-to-one to Bitcoin. It's going to stick to, other protocols of all sorts, which are going to grow faster than Bitcoin. But Bitcoin will still be the biggest beneficiary of all sorts of capital moving on chain, and this allows for capital to move on chain, right? Even tokenized stocks are a big deal. If you happen to have tokenized stocks on chain, that's liquidity that you have on chain as opposed to having it stuck in the TradFi world and having to go for a wrapper like MSTR or for a wrapper like an ETF, right? And of course, why will MSTR benefit? Well, you know why? Because MSTR is the biggest holder of Bitcoin. And lastly, let's conclude. Why does it matter for STRC stretch? Why does it matter for stretch? Well, it matters for a lot of things, but it matters because passive yield in the USA will remain allowed only for TradFi. But stretch is likely, I don't know, but my argument for stretch is going to remain the same, which is it serves as a Santi stablecoin. So a stablecoin that's like $100. It's a $100 bill that pays 11.5% that lives in the TradFi universe. And so most of the USA flows, not flaws, flows. Most of the USA flows are gonna stay, I think, in the TradFi world, and they're gonna stick to stretch if stretch becomes more popular. So essentially, thesis unchanged as far as stretch is concerned on this, even though we talk a lot about stable coins and yield. I don't see people selling stretch on TradFi rails to do what? They can't even bring that. They can't even bring it to crypto and buy a stable coin that pays a yield in the crypto land, because that's not going to be allowed. Only rewards are going to be allowed. So to me, this changes nothing. This is very bullish. And changes nothing for stretch, and then it changes nothing for the stable coins that I've built on stretch outside of the US. Like APYX is not compliant with. Okay, I don't want to be that categorical. I don't know what their plans are, but for now, many of these stable coins are not available in the US, right? And I don't think they will be available in the US, but they'll be available, in the rest of the world. Or maybe they won't. Maybe because they want to have the U.S. market and they want to comply with U.S. law. Maybe they will be like, okay, well, it's a bigger deal to have the U.S. and so let's turn these STRC based stablecoins. Let's turn them into some sort of a rewards based stablecoin, where instead of getting cash, you get some sort of a reward. And I have no idea what that could be, but we'll see. But clearly, if they wanted to cater to the U.S., they would have to change the way it works. That's kind of the way I think. Oh, and a big question mark, and this will be for the regulator to figure that out. A big question mark is what's going to happen to staking, because a lot of these protocols work with actually staking the stretch enabled stablecoin. So this is also like a point that I think the regulator will have to figure out when they do rulemaking after this is signed by the president, is where does staking stand? Because I've read about transactions, lending, spending, loyalty. What if you stake a stablecoin for yield? Does that count as an activity or not? Right? Maybe you just need to add a queue. Maybe you can be like, okay, you can stake your USDC, but you have like a 10-day queue to get your money back. And in that case, they don't treat it like a checking account. Still, some question marks remain, right? But that's going to be for the regulator then to do some rules and rulemaking. And lastly, I'll conclude with this, and this is another point of inquiry. I wonder what happens if tokenized STRC comes on a decentralized exchange. As I've covered last time, there's a tokenized strike on Hyperliquid. On Hyperliquid, if you happen to be able to use Hyperliquid, i.e. you're not in the US, if you're not in the US and you're allowed to use Hyperliquid, you can buy Strike, STRK, on Hyperliquid. What if Stretch soon comes and is introduced on Hyperliquid, and you can buy a tokenized Stretch on Hyperliquid, and then what if Hyperliquid becomes compliant with the USA and becomes legal in the USA? Does that mean you can just buy a tokenized STRC on crypto rails? And then in that case, it's just a matter of definition whether your stablecoin pays a yield or not. Anyways, my main point in this video is that the drainage of fiat will continue. The one-way passage to the world of Bitcoin or to the world of digital credit, which flows to Bitcoin, that world will continue and accelerate with the passage of the Clarity Act. And so I think this is a very, very bullish thing going on here. So anyways, this was not investment advice. This is not financial advice. This is only entertainment. I'm hoping you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.